I think the Fed is done in terms of the rate hikes. I don't think the Fed is aware, if you like, or believes that is the case. But our view had been, back in June 2020, I think we both agreed at the time, we saw inflation hiking. But May of this year, we felt that we could have seen the peak. So in May, we felt inflation has peaked peaking with year-end targets around 6.5%. And we think that if the trajectory of the inflationary pressures continue to decline, then what the Fed will probably do is wait in February, pause in February to see if the inflationary pressures continue to decline, especially the core. And if that is the case, by the time they have the March meeting, which is on the 22nd of March, they may decide, you know what, we're already in tightening mode, QT is taking place, unemployment rate has risen, housing market's a little bit off, stock market is off, and we basically pause it a little bit further. So it could be a broad pivot, not actively. But having said that, I think they will maintain, and they should maintain, a hawkish verbal stance.
So the December CPI comes out on January the 12th. The January CPI comes out on February the 14th. So the DEC figure and the Jan figure, Jan 12th and Feb 14th. You need some big downward ticks on those if you're going to be right.
Well, you don't need significant large ticks. I don't think we need to see a sort of a 5% handle. Even if we see a low 6% handle, so if we see sort of 6.8, 6.2, in our view, that should be sufficient for the Fed to say, you know what, the level of momentum on the declining side is sufficient for us just to wait for pause for February and reassess 22nd of March.
Let me hold your hand and walk down that road with you. It's not that funny. Hold a lot of men's hands.
Walking.
So I'm going to walk down the road with you, Thanos. It may be unnerving for you, me holding your hand. But in terms of what the market will do, because the market is now really fed up. It's like, oh, we've got a terminal rate of 5.1% at the end of 2023. Oh, I'm so fed up with that. But you're scything those estimates. What does the market do in early next year if there are no more rate hikes?
So I think that number one, in terms of the fixed income side, in November we turned positive fixed income. We were negative fixed income throughout the whole year because of our view on inflation. We sort of turned positive dollar again, if you like, in February 21 at 105 because we thought the Fed is going to be raising interest rates. But more recently, we felt that the yields are attractive. So we turned positive the 10 years, positive the 2 years. So we continue to see the support on the fixed income side. On the equity side, however, we do still expect a correction in terms of the earnings and for the equity market to come off because of the slower economy, because of the tightening.
Over the cost of financing being scythed by... won't that be exciting for the market?
It will be, but we are still in a tightening period. We are in a tightening market, and I think that's why the Fed will basically, in our view, will take the risk of waiting in February, because we are in tight periods, plus the QT as well.
You're not the only one of this view then, by the seams of it, right? You do have the Double Line Capital CEO, Jeffrey Gundlach, who I think for me was very interesting, saying that weakness in the economy is the main reason why there needs to be a halt, or should be perhaps that halt in these interest rate hikes of that pressure. But he predicts then CPI falling to around 4.1% in June. That's still the case in your thoughts as well? I mean, that would be a good drop-off from where we are now.
Yeah, I'm not sure if we're going to go as low as 4.1 as soon as June. Yeah. Our view, however, is that we are not going to go back to the 0 to 2% rate. And I think this is a key deviation from us on the Fed. The Fed and the ECB continue to say anchoring is 2%. Yeah. And to be fair, I had a chat with the ECB the other week, and it is important for them to maintain that as an anchor.